For us, what it means is that this will give us the rebalancing of the market. We can see a rebound of the prices with time, so we don't have to produce oil and give it out for free. And we have started seeing a sign that this works by pulling down the supply and creating a balance that will come to a situation where we can at least recover our costs and make some margin out of this business. So it's a good thing to do. For us, it's a must-do activity.
Does this mean that you're going to close the discount to Brent that you've been selling your oil at?
No, absolutely not. Discount will go away definitely within the shortest period of time. As you know, what we did in the last 2 months was to close that gap much shorter than what it was. And by the end of June or July, we'll see a situation where we can take out that discount. It's no longer necessary.
When do we get to full compliance? In other words, what you've committed to in this deal, plus the overproduction of the earlier months, Mele?
Yes, there was a marginal under compliance, less than 100,000 barrels per day. And as in current numbers, if we look at day-to-day numbers in the last 10, 15 days, we're actually on over-compliant position. So definitely by the end of June, we'll see full compliance from Nigeria. And the worst-case scenario is maybe half of July. Otherwise, we're in good shape.
Mele, do you think the deal that was struck by OPEC Plus creates a floor for oil? Is the floor $40? What will this deal do to the price of oil?
What it will do to the price of oil is to bring some form of normality by the end of the year. Probably we can see a flat out at maybe 42 to 45 at the end of the month, at the end of the year. And you can see the short-term response as a result of the OPEC Plus intervention. And I don't think that's completely sustainable, except the production cuts are implemented to the full by end of July. If that happens, we'll see a sustenance of the current level of the $40 to the Brent and potentially grow to the region of 42, 45 by the end of the year. I think that's created a flow. I don't think we'll ever see any sub-30 oil in the near future if this situation is sustained.
What does all this mean for CapEx at NNPC, the business you run?
Yes, some of our assets produce at less than 30, so it's good business today that we produce at less than 30 and we're selling at 42, 40, then we're in comfort zone.
But are you going to have to cut capital expenditure this year?
We're doing that. Our target is to bring down cost to $10 by the end of 2021. We have insisted on making sure that our partners and all our suppliers cut their costs by at least 30 to 40%. And that will significantly bring down our costs, and it's very realistic, and we're realizing that now. As
we trade around this $40 to $42, do you think it's going to, let's say $45 on an optimistic level, do you think it's going to make compliance within the OPEC Plus family, do you think it's going to make it harder or more difficult?
Not at all. Everybody's seeing the benefit of creating this balance in the market, and it will be in the informed interest of all of us to comply. So I don't see the challenge with that.
What about Saudi Arabia, Kuwait, and the UAE taking out the extra voluntary cuts that they did? That seems to be a little bit of pressure on the market. Is that more pressure on Nigeria, Iraq, and is that more pressure on you to comply?
Yes, of course, not really, because it's really a decision that we have made that we're going to comply, irrespective of the actions, unilateral actions of our partners, which is serving the purpose of all of us. I don't think it's a challenge for us or there's any additional pressure on us.
I'm looking at BP. They're announcing swathes of job cuts. I hear you when you say you're trying to make the business more efficient. Can you escape this year without job cuts at NNPC?
We will escape this year without job cuts in NNPC. We are reviewing other heavy cost areas so that we can bring our cost to normality. But I know also that in terms of our partners, many of them are looking at a situation where job costs will be unavoidable. But what is informing that much more than the cost is actually the issue of the improved efficiency that we have seen in the last couple of months.